The broadcast is now starting. All attendees are in listen-only mode.
Okay. I hope everybody out in webinar land can hear me. Mark, can you hear me?
Oh, I can hear you.
Okay, great. We are broadcasting live from multiple locations today, one from Camp Hill, Pennsylvania, and the other from Lancaster, Pennsylvania. So Mark, how you doing today? Good?
I'm doing great. I'd like to throw in here that they literally never let us just run these webinars and kick things off. So I hope you're prepared. Yeah, I hope you're prepared for things to be a little less official than Melissa would have us normally do.
How about it? Seriously, I mean, it's kind of like letting the mice play while the cat's out, right? So
That's right. That's right.
All right. So anyways, I'm supposed to give this introduction. It says, good afternoon, and thanks for joining us for today's webinar entitled The CARES Act and the Benefits for Small Business. My name is Dave Blain. I'm a partner with the firm and the Director of Entrepreneurial Services at McKonly Asbury. And with me is the great Mark Heath. Mark, you want to say hi?
Hello, everyone. Happy you're here. Wish it were under better circumstances, but my name is Mark Heath. I'm a partner with the firm and Director of Tax Services.
Mark, thank you very much. So before we get started and get into the detail here, just want to let everybody know that if you have questions for us during the webinar, please feel free to submit them through the built-in questions function in the webinar control panel, and we will do our best to answer them during the webinar. So we will try to answer as many questions as we can. I think what you're going to find with the information that we have here, that a lot of your questions I think are going to get answered. Basically what happened here is Mark and I have spent the past couple of days looking at the Act, reading through the Act, identifying the key components inside the Act, things that would impact the small businesses that we deal with on a regular basis, and trying to outline that as much as we possibly can so we can get this information out to you as quickly as possible, because I know there's going to be a lot of questions about the tax concepts in the Act, but also about the payroll protection loans. So without further ado, let's go ahead and get started here. Hold on a second here. I am having trouble advancing these slides here. All right, there we go. So, all right, here we go. We got a little too far ahead there. Let's see what happens here.
This is why they don't let us do this normally.
So let's get, hopefully this will get us back to, all right, so the outline for today, everybody, is we're going to talk about the Coronavirus Aid, Relief, and Economic Security Act. Coronavirus is probably going to become a cuss word in the dictionary after this is all said and done. We're going to talk about the key provisions on the CARES Act as it relates to small business and recommendations for utilizing the benefits of the CARES Act. All right, we're going to advance to the next slide here. Okay. So the long and short of the CARES Act to start with here is it's a $2.2 trillion bill that was signed by the president on Friday night. And it got through Congress, and I would say whirlwind speed. I don't think we've ever seen Congress move at such a fast pace ever, but that's what we saw with Congress. And it provides a couple things to start with. And the key to the act is really getting liquidity back into the marketplace for individuals, businesses, both large and small. So what you're going to see is you're going to see recovery rebates to individuals. We're going to talk about loans, loan forgiveness, enhancements to unemployment benefits, tax relief to individuals and businesses, and retirement plan distributions and loans, and how that's going to work within the act. So moving on to the next slide here. All right.
So the kind of the headliner to start was the checks that are going to be coming out to everyone here, hopefully very soon. I know the goal of the administration was to get cash back into people's hands as soon as possible. So you'll notice there's some technical language here that matters. These aren't just checks coming out to people. They're technically advances of a 2020 tax rebate. So how they're going to do this is they're going to look at your 2019 tax return if you've filed one already. And if not, they're going to look at your 2018 tax return. And if you have not filed a 2018 tax return, whether it's because you didn't have to or for whatever reason, they're going to look at your Social Security statement. So, so don't worry, nobody's going to be left out. Now, the one eligibility requirement is that you have to have a Social Security number. So if you don't have a Social Security number, they technically don't know you exist for purposes of this, so they can't get you a check. The amounts are going to be $1,200 for individuals or $2,400 for joint filers, and $500 for each child that you have. So like we said, it's going to be based on 2019 and 2018 returns because there's a phase out piece here. You know, obviously they don't want to be giving $1,200 to millionaires. So it's going to start for individuals. If your AGI, your adjusted gross income, is $75,000 or higher, it's going to start to phase out. So the phase out is it's going to be decreased by $5 for every $100 that you exceed the AGI limit. So if you're single and your AGI in 18 or 19 was above $99,000, you're not going to see any money from this, assuming you don't have children. For couples married filing joint, it's $150,000. So double everything. Once you get above $198,000, you're not going to be seeing your $2,400. If you have children, those amounts, you know, obviously go up ratably. You can do the math. I'm not going to do that for you, but no, that's what it is. So now the catch is for 2020, they don't know how they're going to do this yet, but they put a clause in there to say we're going to remeasure this as part of your 2020 tax return. So when you file your 2020 tax return, there's going to be something in there that says how much of a rebate did you get in 2000 or during the 2020 tax year? How much of a check did you get? We're going to reevaluate your AGI now and determine whether you got too much money or not enough money. Now, the idea obviously is 2020 is probably not going to be the greatest year financially and for other reasons for most people. So in most cases, I'm guessing the idea is the amount that you could have gotten would only go up. But there's no mechanism in the law to rectify it. So nothing says we're going to send out more checks. Nothing says if you got paid too much, you're going to have to pay it back or you're going to have to pick it up in income. My guess is if you got too much based on your 2020 AGI, you're going to have to pick the excess up in income. If you didn't get enough, I'm guessing it's just going to decrease your tax liability to make you whole at the end of the day.
So basically, Mark, there's wow, the money's going to come out. The fact is there's still some loose components here to try to figure out that the feds have to figure out in regards to overpayments or underpayments at the end of the day in 2020, correct?
Yep, and they have, if they have your bank account information because you included it on a tax return, it's going to go right into your bank account. If they don't have your bank account information, then they're going to be sending you a check. They did say there's going to be a secure portal set up so that if they don't have your bank account, that you'll be able to upload that information so they have it, so they can get the money right into your bank account as opposed to sending you a check, just to get everything out faster.
Another question quickly for you, Mark, that has just come in. It relates to the $500 to children. Is that $500 on top of, say you're a married filing joint, it's a $2,400 rebate. Is it $500 on top of that? Or are we saying that if you're a child and no one else can claim you as a dependent, you're going to get a $500 check?
It's $500 on top of the $2,400. So if you're married filing joint, you have one child, you're going to get $2,900, assuming your AGI is not above $150,000.
Okay, great. All right, let's keep moving on here. Let's talk about the next item, which I think is the big item for a lot of people are interested in, and that is relating to payroll protection loans. So with the act that was passed, access to nearly $350 billion in loans under Section 7 of the Small Business Act, and that will be administered by the SBA. And again, the whole intent of these payroll protection loans is that the way the federal government is looking at this is that they want to get individuals back onto the payrolls of organizations, get them off unemployment, and allow those individuals to stay on your payroll for an extended, for the period of time that the loan amounts are set there to help with supporting those payroll costs. And the intent again is that when everything starts to turn around, the federal government wants to be in a position to say that everybody has people in place. The economy's ramping up. We have people in place. We can start right away with getting back to work instead of going through the process of having to go through and rehire a bunch of individuals. So that's ultimately the long and short of the intent here. And with the intent of the payroll loan, they're also trying to give some benefits to small business through this loan forgiveness program that we're going to talk about here in a few minutes. So basically, the general requirements are to get a payroll protection loan, it's fewer than 500 employees are in your business, and that includes sole proprietorships and nonprofits as organizations that can apply for these payroll protection loans. And the covered period of the loan is going to be for the period of February 15th, 2020 through June 30th of 2020. And what that covered period means is that they're looking for at least an 8-week period of payroll coverage, and that payroll coverage would have to be during this time period. And to get this loan, the loan requirements, and we're going to talk about this here very, very soon, the loan requirements are very simple. It is that you have to be able to give a good faith certification that the loan is necessary due to current economic conditions and the uncertainty of the business environment. If you can, I think most of us can attest that we have uncertainty in the business environment. You can do a good faith certification on that, and basically what you'll be able to do is apply for this loan, and more likely than not, be in a good spot to get the loan for the amount that you're looking for here. So let's move on here to the next slide. Let me make sure we can get there. Okay, so the way this is going to work, the way they set this up is they're going to have, in most instances, they're going to look at what your average total payroll costs are for a 1-year period. And that 1-year period will be from technically be from the date of the loan back 1 year. And what they're going to do is they're going to look at this on an average basis. What is your average monthly payroll? And then they're going to look at that average and multiply it by 2.5 times. And that will be the maximum amount of the loan, or $10 million. $10 million is the max of the loan. So if for instance, you took your payroll cost, times it by 2.5 times, and it turned into 11 million, they will only be able to give you 10 million. That would be the max of the loan. The reason why they're looking at it from this perspective is the whole intent, again, of this payroll protection loan is to cover payroll costs for an 8 to 10 week period. Hence the reason why they use 2.5 times the average payroll cost. Thinking that if you got the loan, let's just say in an example, you get the loan on April 15th, that should cover you with payroll costs and payroll and other costs of running your organization for at least the next 8 weeks until the coronavirus settles down, that we can go back to work and we can begin to get back to normal working conditions. That is the intent of what the federal government's trying to do. So if you the one thing that we should talk about is, as you see down here under the calculation of the monthly payroll cost, and we're going to talk about what's included in payroll cost in a minute here and what's excluded. But if you look to the right of the example there at the bottom, it talks about seasonal employees. So that is one item that needs to be discussed a little bit. So when you're looking at these payroll costs and you're looking at your average for the last 12 months, if you're a seasonal organization, where you have people that work for you maybe in the springtime because they're doing a lot of landscaping work or something like that, but you don't see them and you don't need them in the summer. You pick them back up in the late fall. They take into account these seasonal employees in a little bit of a different manner. What they're saying in the act is for seasonal employees, you have to identify who they are. You look at the payroll costs last year between February 15th of 2019 through June 30th of 2019, and you figure out during that time period what is the average amount of payroll by month per month that you have for these seasonal employees. You multiply that by 2.5 times, then you add that cost to whatever the non-seasonal employees are and whatever that calculation should be. One thing that should be kept in mind also is if you are a company that just started in 2019, really didn't have any payroll cost, really, or just ramping up in 2019, but you get to 2020 and you're moving forward, and you have an organization where you have employees, you have payroll, you're now starting to really ramp up your business, and you're actually operating. The act does give you the option of looking at payroll for January and February of 2020 and taking that average, multiplying it by 2.5 times to come up with what your loan amount would be. So they are trying to give some leeway here for businesses that were established in 2019, as well as ones that were just in startup phase and are now ramping up in 2020. So they did try to take into account both of those instances. So moving on here, let's talk about how you calculate what payroll is. I'm sure everybody's out there is thinking, okay, well, what defines payroll? So in the eyes of this act, the way to define payroll is it would be any traditional W-2 wages, commissions that you might have earned. Say you're a salesperson, you had commissions, any salary, W-2 salary. And it also talks about independent contractors. So any independent contractor out there that was working for you, doing work that received the 1099, they would also be included in calculating the payroll cost. Other things that you would include is if you're a restaurant or your restaurant or something like that, you had cash tips or some type of thing like that that was being claimed by an employee, you would include those cash tips that were being claimed by the employee for their payroll. You would also include vacation, parental, family, medical, and sick leave. Any types of dismissals or separations. So if you had somebody during the last 12 months that you had to terminate and you had a severance agreement with them, you would pick that up, and that would be part of the payroll cost that you would include in there. You would also include health insurance benefits, any types of group insurance benefits that would be paid because through payroll for an individual. The company, the company contributes a portion of their insurance benefits for healthcare or maybe eye and dental. You would pick that up. You would also pick up any retirement benefits that might have been paid. So if you had a 401k plan and you make a contribution to the employee's 401k plan, say you match up to 3%, you would pick that piece up as well as part of your payroll calculation. And then the final piece, which is somewhat interesting, maybe Mark can chime in on this, but payment of state and local tax assessed on the compensation of the employees. So it sounds to me like, Mark, what that means is that if you had 3.07% withheld by the state and 2% for local, that would be also picked up as part of the calculation as well.
Honestly, I'm not quite sure that's what they're referring to, because technically that would be withholding from the employee's wage. So technically you're paying the wage to an employee, but withholding a certain portion of that to pay on their behalf to PA or whatever state or whatever local taxing authority. My guess is that refers to state probably unemployment tax, and maybe, like in PA we have that $52 EMS tax. I'm guessing that would be included in this. And yeah, these are all details that we're going to be working out here over time. So I'll make sure to plug our landing page of our website, which is now the COVID-19 resource page. That's going to be updated, literally every day as stuff changes. So please check back there, macpas.com. The one thing I do want to point out on this slide is, anytime you see at the top where it says wages, commission, salary, or similar to an employee or independent contractor, anytime they use in a law something that broad that just says similar, they're looking for any kind of wages, any kind of compensation that you're paying to someone to be included in this. And again, this is just a measurement to get kind of a rolling average to see what kind of loan you really need to keep paying the people who are relying on you to get money for their work to put food on the table, whether they can work or not. So that's what they're going after here, which is a signal they're doing it the right way. They really want to get money out to people who are otherwise, their paychecks, their revenue stream, however they're getting paid, just went from whatever it was to zero.
Thanks, Mark. Appreciate that. So we talked about what makes up payroll and how you would, what gets included in payroll. Let's talk about what gets excluded in payroll. All right. Well, before we get to what gets excluded for payroll, let's just talk about sole proprietors, independent contractors, and those that are self-employed individuals as well. And the payroll costs are the sum of the payments of any compensation to or income of a sole proprietor or independent contractor that is similar to wages, commissions, income, net earnings, and self-employment. And it's limited to not more than $100,000 in that year prorated over the covered period. So what that means is that as included as part of the calculation of payroll, when we saw earlier, it talked about wages, commissions, salaries. If you're a sole proprietor or you're self-employed, you would include in that calculation as well any wage that you might have taken. So if you're if you're an S corporation, you have wages, and you're taking a wage, you would include that. You would include also any of your net earnings that you received through your organization that may have flowed down to you in your K-1 or similar compensation for that. But they limit it to $100,000. Now, there is some questions about this $100,000 that we are still yet to get an answer from. So one thing I want to make sure everybody out there understands is that some of this is still in moving. Some of these stuff has some moving parts to it. One of the moving parts does relate to this $100,000 because it's being looked at in two different ways. Is it if you make more than $100,000, you're fully excluded of having that wage and salary and income and included, or is it up to 100 and anything over 100 is excluded? We've talked to different people. We've talked to an individual that's pretty tied in with the SBA here in the Northeast region of the United States, and he even said they're not sure how to define that. But we've seen different types of guidance out there that leads you to believe that it's compensation up to $100,000. Anything over $100,000 would be considered an excess and not included as part of the payroll cost. Mark, any thoughts on that? I know you want to talk about it, so.
Yeah, I've been reading tax code for 25 years, so while I'm not a lawyer, the way this bill is written is pretty similar to language they use in the tax code. Anytime I see the word excess, that tells me that they're looking at just the amount over $100,000. So that's kind of my literal reading of it. I'm guessing though, because everyone's asking this question. So once they release the regs on this, I'm fairly certain they'll make sure we understand their intention there. But also, I mean, $100,000 for an annual salary is a lot of money, and particularly in central Pennsylvania. You go to Philadelphia, suburban Philadelphia, you go to Manhattan, you go to suburban DC, Northern Virginia, $100,000 isn't a ton of money. So my guess is they had to pick a cutoff, and so they cut it off at 100, meaning that only the excess is not going to be allowed to be included. Otherwise, there would be so many companies out there who wouldn't really get any benefit from this.
Yeah, I agree with you 100%, Mark. I mean, if you excluded anybody that made $100,000 or more, then the intent of the act really wouldn't meet the requirements of what they're trying to do, because it would exclude a significant amount of people. Because $100,000, I mean, it is a lot of money in today's world, but it's, you know, with inflation over time and the way salary costs have risen, that $100,000 isn't the same as what it was 20 years ago. So you would exclude a lot of people. So we think that's what we're pretty sure that's what the intent is, but the SBA still needs to give clarity as to what that actually means. So I don't want to mislead anybody out there that this is 100% proven. We are still waiting for the SBA to give guidance on that. So, yep.
Yeah, let me, I'm just looking at, we're getting questions literally every like 8 seconds here. So we're going to try, you know, as we're talking, we're kind of answering some of them as we go. I'll be honest, a lot of these questions just aren't addressed in the bill. We're going to have to wait for the regs to clarify all this. In particular, the FICA FUTA, I don't think is addressed. My guess is that's not included in payroll costs, but we would want to check on that. We had a question on the $500 check for qualifying child. Qualifying child is anyone under the age of 17. So that's their definition of child there. Independent contractor. That's one thing I was wondering too. The payroll costs. If it's just to an individual who's an independent contractor, or is it a business? Do both of those qualify? To a business, I feel like no. But again, it's something we're going to have to get clarification on. What if the business is a single member LLC, that you're just sending a 1099 to what's technically a business, but is really just an individual? My sense is that would qualify. Owner draws, I don't know, because it's not, if you're not qualifying it as a guaranteed payment, you're just qualifying it, calling it a distribution. My guess is no if it's a distribution. If it's a guaranteed payment, my guess would be yes. But again, all these we're going to need more clarification on. I'm just scrolling down through the questions here. S corp owners.
Yeah, I was just getting ready. Yeah, I just saw that one too. S corp owners considered employees, or
if you're active in the business. Yeah, if you're active in the business, you're going to be an employee. And if you're not active in the business, you wouldn't be self-employed because you're not active in it. So it would be passive activity.
Can a local government entity qualify? I don't think a local government entity can qualify, because it talked about being businesses or for-profit or non-profit entities. So I don't know if a local government entity would qualify for this, because the other thing about local government entity is that they have taxing authority to begin with, where they can raise or set property taxes and sales tax or local taxes. So I don't know if a local government entity would qualify for this. Let's keep moving on here a second. So the payroll costs that you will not include in your calculation are going to be the compensation of any employee in excess of an annual salary of $100,000. And again, we're still trying to get clarification from the SBA on that, but it is believed that it would be in excess of $100,000. Also, you would not include payroll taxes. So it is just the pure wages. Yeah, it is just the pure wages. The compensation that we talked about in the earlier slide, payroll taxes are excluded from this calculation. Also, if you have employees that live outside of the United States, they would not be you would not include their wages and salaries in this calculation. And then finally, as we saw on March 18th, that the president signed into act the Families First Coronavirus Relief Act. If you are qualified inside that Relief Act and you're taking credits for the 80 hours that you are giving for emergency leave for anybody that's impacted by the coronavirus or is in a quarantine state, you cannot take those credits as part of the payroll compensation that they're looking at for the PPL loan. The other thing about these loans is that there'll be 10-year maturities with an interest rate not to exceed 4%. Now, we're going to talk a little bit about the loan terms, but also how do you get some forgiveness on this loan, because there is a loan forgiveness clause inside of this act. So if I can move this forward. All right, here we go. So when you do apply for the loan, again, the loan will be based on looking at your payroll costs. They're going to multiply that we talked about, multiply it by 2.5 times, and that would be the maximum amount of the loan, or $10 million, less any of the other costs that we talked about. When you receive the loan proceeds can be used for basically general operations of your business during that time. It would be to cover payroll, it would be to cover mortgage payments, it would be to cover rent, utilities, and other debt service matters. So if you have equipment that you're leasing, that would be included under this. Again, it would be the mortgage payments, it would be the rent on your facility that you would be able to cover, any types of utilities, anything that you would need for general operations of the business. The money that you receive in this loan can be used to cover that. The beauty about this loan right now is the way they set this up is that there's no standard fees imposed by the SBA. That's all waived. And unlike SBA loans that would be like if you went and used the disaster emergency assistance loan, or you were going for a traditional SBA loan, there is no personal guarantees on this loan. It is purely based upon what the calculation is for your payroll, and you have the payroll support for that. So you won't have to go through the arduous task of doing your personal financial statement or giving 3 years of financial data with balance sheets, multiple income statements. What they're going to be looking for is the payroll information that will allow the SBA lender to be able to identify whether you qualify for the loan or not. And also there's possible deferment of repayment of loans for a period of at least 6 months, but not to exceed a year. So that means you can qualify for not even having to start the repayment of the loan for at least the first 6 months of the loan as you have it. Again, they put that in place because they want to make sure that business has cash, they can continue to operate, they can continue to have people on payroll, and if things move slowly over the next 6 months, that will allow for that deferment over time until you have to make that first loan payment. Okay. So here's the beauty of the loan, and that is this loan forgiveness. So basically how this is going to work is that you're going to go to your bank and your SBA lender, and if you qualify, you're going to get this loan. And as long as you use the money in accordance with what was outlined, and you keep your employees in place, you can get loan forgiveness for a good portion of your operating costs for an 8-week period from the time you receive the loan through that first 8 weeks. So basically, and it will be tax-free, on a tax-free basis. So the amount forgiven is the sum of the following payments made during the 8-week period beginning on the date of the loan. So if you get the loan on May 1st, you'll have an 8-week period from May 1st, as long as you can identify that you spent the money on payroll costs, defined as what we talked about in the previous slides, as well as mortgage, interest, rent, and utilities, just like we talked about earlier. So you'll need to apply for it. You'll need to fill out an application saying you're applying for loan forgiveness, and as part of that loan forgiveness application, you will provide this information to say, here's what my payroll costs were for that 8-week period. Here's what my paid mortgage interest, I paid in rents, I paid in utilities, I paid in costs for leases, for equipment, to operate my business. And by showing that, you then will be in a position that the federal government will forgive you for those costs that you incurred for that 8-week period. So that is a pretty nice little incentive to bring your employees back and keep them on the books. And again, the whole intent here is federal government wanting to get employees back employed by the employer, so they're ready to ramp up and go back to work, and also get them off the books of unemployment. I mean, it's really what it comes down to, and reduce the unemployment rate. So again, the application required to seek forgiveness, application must include documentation verifying the number of employees and the pay rates, canceled checks showing mortgage, rent, and utilities. So the canceled check thing seems a little odd to me. because we don't. A lot of organizations don't even use checks anymore. A lot of EFT payments, but I would assume that as long as you can show through your bank statement that you made these payments or you made these EFT payments, that would be sufficient for the loan forgiveness application. The other thing to keep in mind too is the number of employees. So you need to have, and we're going to talk about this here in a second. Let me advance this slide here. Yeah, so amount of forgiveness is reduced if the employer reduces its workforce during that 8-week period covered when compared to other periods in either 2019 or 2020. So basically what they're saying here is on the date of the loan, you may have people laid off. You're going to bring, you'll bring those employees back because they're going to look at what has been your average headcount for the last 8-week period. And you're going to bring those employees back. And as long as you keep those employees and that average headcount in place for the next eight weeks, and you don't do anything to significantly reduce salaries, as you can see in the second bullet, reduces salary or wages paid to an employee who had earned more than $100,000 in annualized salary by more than 25%. As long as you don't reduce salaries, and you keep these employees in place, you will qualify for the maximum amount of the loan forgiveness. Now, if you're in a situation where you get the loan and it's not working out, you have to reduce payroll, that's okay. It's just that you're not going to get the way that works is that your loan forgiveness amount reduces by the percentage of the amount of salary cost and headcount that you reduced of your organization or of your employees. All right, so let me see what we can do here. All right, let me go back here a second because I think we went a little too fast. So here's kind of a look at how this is actually going to work on the loan forgiveness side. So reductions in employment or wages that occur during the period beginning February 15th and ending 30 days after the enactment of the CARES Act as compared to February 15th of 2020 shall not reduce the amount of loan forgiveness as long as by June 30th, the borrower eliminates the reduction in employees. So in other words, as long as you can have these people laid off and go get the loan, you get the loan, as long as you've brought these individuals back and they're back on your payroll before the 8-week period or before June 30th gets here, you'll qualify for this loan forgiveness. So at the bottom here is kind of a calculation on how this loan forgiveness would work. So you would take, you're gonna take your payroll cost, calculate it from what we talked about earlier. You're looking at your average number of full-time equivalent employees per month for that 8 weeks beginning on the loan origination. And then you're going to divide that by either the average number of the FTEs from that time period, that similar time period in February to June of 19, or you're going to look at it from January 1 of 2020 to February 29th of 2020. And then, of course, for the seasonal employees, as we talked about in regards to their headcount, that's going to look back to a retrospective period of February 15th through June 30th of 2019. So that would be, so that's how we're going to look at it when it looks at a reduction based on reduction in the number of employees. If it's related to salary, you're going to look at the payroll cost and you're going to subtract that from any employees who did not earn any wages during the 2019 at an annualized rate of more than 100,000, and that you didn't reduce their salary by 25%. So long and short of it is this: you go to apply for the loan, get the loan. If you have employees that are laid off at that point in time, that's fine. The fact is you got to bring them back, and you have to bring them back and make sure that during that 8-week period you have yourself a situation where you have an average headcount that's similar to a similar period before you receive the loan, and therefore you would qualify for loan forgiveness, or at least the maximum amount of loan forgiveness. So that is the kind of nice thing about this program, is that you can get this money, help you operate your business, but it will also be give you a situation where you can get that debt off your books as long as you use the money in accordance with what the intent was. Okay. So how do you go about doing this? Well, there's it's an SBA loan, so you're going to have to go to an SBA certified lender, and all 50 states have SBA certified lenders. And the way it works is that everybody's excited about going and trying to go out and get this get a loan application done right away and get in line for this SBA loan. Unfortunately, the SBA, because the act was just enacted on Friday, within the act itself, it said that the SBA has 15 days to put all the components together to be able to open this up. And the components would be having the application process in place, having all of the SBA certified lenders lined up and identified in who they are, and also identifying all the requirements and getting more details around some of the requirements of what's needed to complete the loan and the loan application. So there is, as of this point right now, I'm not aware of any application that's out there yet for these payroll protection loans. I would anticipate that at the earliest you're going to see this will probably be early next week. Again, I was on the phone earlier today with an individual I know that is an SBA lender who has pretty tight ties with the SBA in the Northeast region, and he said that his words were they're in a state of chaos because they're trying to figure out how to get this thing implemented and be able to be in a situation that they can get this money out to businesses as quickly as possible. So I would say bear with and stay patient here. Let the SBA do their thing, and hopefully they'll have this in place in the next 7 days, next 5 business days or so. Okay. In the interim, what I would suggest that you do is you get prepared to do the application. So we already know what the requirements are going to be. We already know what the payroll costs are going to be. We already know what the excluded costs are going to be. That's really the big item that I think you need to really be focused on right now, because that's going to be what drives getting the loan. What I would say is, in the interim, what I would do is make sure you have pulled together your payroll reports for the last 12 months. That would be any 940s, any 941 payroll reports. I would go back to your payroll provider and see if they can give you payroll broken down by month, so you can look at it month over month over the last 12 months, starting with starting with March 31st, going back to April 1st of 2019. Look at it month over month, so you can kind of figure out what that payroll cost is. I would also dig into your financial statements, make sure that you have a good handle on what your benefit costs are that you paid, what if you made any 401k contributions for your employees. Pull that data, independent contractor data, looking at any independent contractors that are working for you, that you're sending them a 1099 as an independent contractor working for you, not just a service provider. Maybe it's the HVAC guy coming in or something like that. And I'm talking about anybody who's working directly for you that's an independent contractor. Pull that data as well, so you have all this information at your fingertips, so when the application process does finally open up, you can quickly get in line and be prepared and ready to go with that data, because I'm sure that the SBA lender is going to be overwhelmed right away. So you want to try to make it easy for the SBA lender to approve it, because they can say all the data's here, I feel comfortable with it. They can plug it into their formulas or whatever worksheets they're going to build out, and then get that to finally to the SBA for approval. The other thing I would make sure that you have too is make sure you have a good handle on what your head count is month over month over month, and look at your head count by full-time and part-time equivalents, and make sure that you have that information so you can figure out what that average head count is for looking at the future of getting loan forgiveness, so you can prove in the future that you've maintained an average head count that's similar to what you had before you had to lay anybody off and you had to go get this loan. And then the last thing would be the lender certification, as previously discussed. Just being able to put a document together that just says that, because of the coronavirus and the issues that have impacted my business, we have uncertainty about the future of the business and whatever industry it might be. That way you have that statement that you can put in with your documents, and you're ready to go right off the bat. Okay. So we talked a lot about these PPL loans. We covered a lot of ground on the PPL loans. While the guidance is relatively laid out. I would assume that in the next 5 business days that we will see additional guidance coming out from the SBA as they continue to ramp this up to give more clarity to both the banks and the SBA lenders as well as those that are looking for the loans. There is within the act some relief for larger businesses as well. So larger businesses don't have the similar type of relief that you're going to see for small businesses, but they do have some relief that was provided in there as well. And some of that relief is, it should be for any businesses that are between 500 to 10,000 employees. The CARES Act basically is set up to give these businesses the ability to go get low interest rate loans with a maximum interest of no more than 2%, and also some deferral, so they can get these loans and they can get deferral for at least the first 6 months of principal or interest, and allow them to get back up to speed. The loan application, similar to PPL loans, must be certified, being that you have to identify that, because of economic circumstances and uncertainty, we're in need of this loan. And like I was saying before, unlike the PPL loans, the one thing that these loans do not provide for larger organizations is this loan forgiveness option. You would be tied into this loan over a long period of time at the 2% interest rate. Now, there is some restrictions that we did hear, and a lot of us remember back to 2008 when we had the market crisis in 2008. There were stimulus packages back then as well that were provided, and there was a lot of criticism back then because of what was happening is a lot of these larger organizations were getting these loans, and then the company was using the money to actually go and do a stock buyback or stock repurchases to bring the stock back in house. So these loans are restricted from any types of those activities. They have to be used for the operations of the business. There cannot be used for paying dividends to highly compensated individuals or stock buyback programs. It can't be used for anything like that. It has to be used for the operations of the business. And then the final loan that I want to talk about very quickly here, and I'm going to turn it over to Mark and let Mark talk about some of the tax impacts that we're seeing, is this economic injury disaster loans. Now, they've been in place for many years, and the intent of these economic injury disaster loans have been more from the perspective of if you had a disaster in your area because of a hurricane or a tornado or something like that, and it was declared a disaster area, you could go and apply for these economic disaster loans. In this instance, most states have been declared disaster areas. In fact, today, President Trump signed that Pennsylvania has been declared a disaster area. So that opens up and frees up this money for these economic injury disaster loans. It's unique, obviously, in this instance because we didn't have a physical damage hardship. This is a completely different hardship from a virus that so it's not as if a building was knocked down or we had small towns destroyed from a tornado. This is a completely different story. But you can apply for these economic injury disaster loans through the SBA because we have Pennsylvania is now officially a declared disaster area. And again, these are loans that are more for those organizations with 500 or fewer employees. And the way these loans work is that for any loan made under the program before December 31, 2020, there would be no, again, just like the PPL loans, no personal guarantees for loans below $200,000. The government will pay the principal and the interest on a Paycheck Protection loan for the first 6 months for which payments are due. So this would be something included as additional to the payroll protection loan. Doesn't apply to Paycheck Protection loans previously discussed. And access to immediate cash advances of up to $10,000. So you can basically get $10,000 right away if you are applying for this loan and you can get a preliminary loan approval. You can get $10,000 advance immediately on the loan. So there's a number of different options that are out there right now. The payroll protection loans are obviously the biggest item that's out there that's in this bill that's available for most organizations that appear to be what will be the easiest for small businesses to get. but there is these other options as well if you're a larger business or if you want to look at more of an economic injury disaster loan as well. So we're going to move on here, and I think we're at the point now where we can turn this over to Mark Heath, and Mark can talk a little bit more about taxes.
My favorite topic. So let's take a quick break here. I'm going to go over the questions that we have in the queue. Received a bunch of questions on how do we apply. That's what we're still waiting on. That's what the SBA has to set up. So information on that yet to come. Similar compensation, can it include bonuses, PTO payouts? Yes. Regular employee limited $100,000. That's our understanding. You can only include up to $100,000 per employee in your payroll costs.
Mark, one thing I want to add real quick is on applying. What I would recommend you do is, while the application process isn't there with SBA, I would assume that most SBA lenders in this area, and probably most SBA lenders across the country, will be qualified to do this lending. So I would get in contact with your SBA lender now, or your bank that has an SBA arm to it. Contact them right now, because they're at least going to tell you, based upon what they know, what they're going to be looking for. So you can, again, start to gather that data in advance and have that available and ready. And you can also talk to them about, hey, can I make an appointment? Get in front of them, so you can try to be as upfront and as early in the process as possible. Because think about the amount of small businesses that are out there, less than 500 employees. The amount of applications they're going to see is going to be overwhelming. So if you want to get your money and get your money rather quickly, you're going to need to get out in front of that line, and having that information prepared to be in front of that line is going to be the key.
Yeah, definitely. So scrolling down through the questions here, is there an income limitation to receive the $500 per child? That's going to depend on on the income level of the parents, and that goes back to the $150 for married filing joint. That's all going to be included in there and phased out once you get over $150. Again, child is under age 17, and if you're over 17, but you can be claimed as a dependent, you are not an eligible individual for this. So you are not going to get a payment from this. Why they cut it off there, I don't know. But oh, and here's is the calculation one average month times 2.5 times, or average yearly payroll times 2.5 times? The first time I read this, it kind of reads to make you think it's 2.5 times your annual payroll. In which case I was like, oh my gosh, they're going to burn through this money in like 20 minutes. So no, it's 2.5 times 1 month.
And the way it works is you would look at from the date of your loan back 12 months. If you don't have seasonal employees, it's all typical employees, typical organization. You would look back for 12 months. You would take that, divide it by 12, and figure out what is my average monthly payroll cost. And then that average monthly payroll cost would be multiplied by 2.5 times. So that's again, the whole intent is they want to make sure that you got coverage for at least 8 to 10 weeks of payroll and other operating costs, and that's how they're coming up with that calculation.
What if your child is a college student? Presumably, if they're in college, they're older than 17, so they would not be an eligible individual as a child, so they wouldn't be deemed to be a child for the $500. The next question is, are they able to be claimed as a dependent? If they can be claimed as a dependent on someone else's return, then they will not be an eligible individual. They will not get the $1,200 payment. Mortgage relief, I don't think this is touched on anywhere in here. Is it, Dave?
My understanding on mortgage relief is that it would not be the principal that you can pay on. It would be the interest that would be deductible, or that would be part of the it would not be principal payments. It would be the interest from the mortgage payment that you would pick up as part of the loan forgiveness.
So here's a question we're starting to see a lot. Is there a reason that I wouldn't want to apply for this? There's multiple factors here you need to take into account, because a lot of these provisions between this and the Family First Coronavirus Relief Act offset one another. So if you do one, you can't do the others. So you really have to hunker down here, start running the numbers, figure out where you're going to be better off in all of this. And we're working on setting up those templates to enable people to run those numbers so that they can see what should I be doing here. And part B of this question is, what if I don't need it? What if I have ample reserves? We have clients who, because of the industry they're in, their business is not affected by this, and they are killing it. And it's business as usual. Their balance sheet is strong. I don't see them applying for this. A, because they don't need it. B, they recognize, hey, if I don't need it, why would I take it from someone else? So those are all the factors you need to take into account here. How long should we wait to apply? If you think you're going to need it, I'd be applying, like Dave said, call in your SBA lender today to see if you can get on their radar. Let's see. All right, so let's go back here to the slides. We're going to go over 3 o'clock. Hopefully you can stick with us. I know Dave has another engagement, but I don't have to be anywhere. So, all right. So let me make sure I didn't skip a slide. I did skip a slide. Which direction am I going here? All right.
I think that's right. I think, yeah. There you go.
So the employee retention credit. 50% of all qualified wages in a quarter, if you are under 100 employees, you can get up to $10,000 per employee. It includes health insurance. You can get that as a credit against your payroll taxes. So again, just reading through that, you take your all of your qualified wages, multiply it times 50%, including health benefits. If you're less than 100 employees, you can get that in a quarter, again, as a credit against your payroll taxes. If you're over 100 employees, it's limited to the wages paid to employees who cannot work due to COVID-19. So if you're over 100 employees, you take all the wages that are paid to employees who can't work, whether they have to be home with kids, whether they're sick, caring for a sick person, whatever. That's what you would include in this calculation. This is all going to be reported through your 941, through your payroll tax returns. And I'm guessing ADP, Paytime, Paychecks, all the big payroll providers are ramping up their systems right now to be able to calculate that. But you need to start tracking this now to make sure you can get them the information so you can get these credits if that's the route you want to go. Because like I said previously, this cannot be combined with payroll or the Paycheck Protection loans. So you have to pick one here, which is why it's important to make sure where you're going to be better off. The wages period that you can use this for is March 12th through December 31. You can get it each quarter that you qualify. And so, and basically you qualify if you're affected by coronavirus, which it's pretty safe to say that pretty much every business will be considered to be affected by this. So if you're shut down in a quarter, for that quarter, you would automatically qualify, even if it's just for a day. If you're shut down the next quarter, you would qualify for the next quarter too. There's also a gross receipts test for this. So if your gross receipts drop by a certain amount during a quarter, you're going to qualify and you'll be able to get this. I'm going to be moving quickly through these because there's a lot of details that I could spit out to you right now that you're not going to remember. But all the details will be included in the guidance that you can read and make sure that we get all of that. Payroll tax deferral. This is going to apply to everybody. So your payroll taxes for this year, any payroll taxes due from the end of March through December 31st are deferred for an entire year. So this refers to the employer portion of the payroll taxes, so that you would remit to the IRS. So you're going to be able to defer all of them. Half of them are going to be due on December 31st, 2021, and the remainder, the other 50% of the payroll taxes that you deferred are not going to be due until December 31, 2022. If you're self-employed, you're going to get a deferral on half of your payroll taxes because you're paying both sides, both the employee and the employer portion. So they're going to defer half of those for you. Net operating losses. Darn
it. You okay there, Mark?
Every time you click on the screen, it advances. So net operating losses.
Mark, real quick, if you don't mind, can I interrupt real quick on the payroll tax deferral? So if you applied for the Families First Coronavirus Relief Act that was signed into law about 2 weeks ago, that is related to like emergency pay for individuals that are impacted by the coronavirus because they're either, they've been quarantined, they have a stay in place order, or they have a child care issue that impacted them because their child care closed or the school's closed or whatever. In that act, there is also payroll tax deferral on the wages that would be paid for sick leave and for other wages for 80 hours or for a 2-week period. How does that payroll deferral impact this in the new bill? Like if you're
yeah, that's unfortunately I don't have all the details in front of me. That's something that we're going to have to work through in the details in the guidance. But this is all, I just want to make sure we cover high level what's out there to make sure people are aware of it. Because there's not much you can or have to do today for this stuff. We just need to make sure that we're aware of it, so that make sure we're looking at it and make sure we go out and get the appropriate guidance.
It's kind of like drinking from a water faucet, right?
You mean a fire hose?
A fire hose, I mean, yeah.
Yeah, there you go. So moving on to the additional business tax stuff, net operating losses. So the Tax Cut and Jobs Act that was signed at the end of 2017 said net operating losses can no longer be carried back and can only be carried forward. They can be carried forward indefinitely, but when they're carried forward, you can only offset 80% of your taxable income. Obviously, hindsight now being 2020, that's a terrible idea. Obviously, the economy was doing well. No one had any idea that this was going to happen. So now, any net operating loss that arises in 2018, 19, or 20 can be carried back 5 years. So why is 5 years a big deal? For C corporations, the income tax rate in 18 dropped from a max rate of 35% to 21%. So losses arising in 18 can now be carried back to those years where tax rates were higher, and you can get a lot more tax back. Same thing with individuals. Everybody was in a higher tax bracket in 2016-17. You can carry these losses back to those years, offset income that was taxed at a higher rate in those years. So this, combined with some of the other stuff we're about to talk about, could be a pretty big deal for a lot of companies.
Mark, quick question that just came in was, which taxes are deferrable? Is it all or only Social Security? I believe it's just Social Security. It would be consistent with the PPL loan as well as other lending practices of the SBA, but I believe it is just the Social Security piece, right?
You got it. It's just Social Security. AMT tax credits, again, as part of the Tax Cuts and Jobs Act, AMT on C corporations went away. And they said you can refund your AMT credits up through 2022, 50% per year. So now they're saying AMT credits can be fully refunded in 2019. So if you have an AMT credit carry forward that you're carrying that you've been getting partially refunded in 18 and possibly already part of it in 19, you can get all of that refunded in 19. You can also elect to receive that full refund in 18 if you're in a position where you haven't filed your 18 return yet, if you're a fiscal year filer, or what you can do is you can file a request for a tentative refund claim, which basically says, we're overpaid because of this AMT credit. We want to give you this money. We want you to give us this money now. You get the tentative refund, and then you have to true everything up on your 19 return or your 20 return if you've already filed 19. So AMT credits you should be able to get back as soon as the IRS can process your paperwork. The business interest expense limitation, this was a big deal in the Tax Cut and Jobs Act 163J. So basically they just said 30% of your taxable income, of your adjusted taxable income, which is your taxable income, adding back depreciation expense and your net interest expense. Your interest expense is going to be limited, excuse me, to 30% of that. That was the old law. So now we're saying for 2019 and 2020, we're going to increase that limitation to 50%. This does not apply to partnerships. So partnerships, the limitation is still 30%, but if you did have interest expense limited for a partnership, half of that is going to be allowed as a full deduction in 2020. The other half is just going to go into the pool of indefinitely deferred interest expense. And then you would go back to the original law to figure out when you're going to get that deduction. Second piece of this is you can use your adjusted taxable income number for 19 to calculate your limitation in 2020. Now, why is that? So it's 2020, we're expecting a lot of companies to have net operating losses. So all of your interest expense would be disallowed, or at least deferred for that year. So what they're saying is if you were an income for 19, you're going to want to use your 19 adjusted taxable income number to calculate the limitation in 2020 to basically, again, increase your net operating loss in 2020 that you can then carry back as far back as 2017. Qualified improvement property, you're probably sensing a theme here. Tax Cut and Jobs Act, this was just a blatant error in the drafting of the law where they said, they changed the definition of leasehold improvements to qualified improvement property. And so they kind of grouped it all together. They said, if you have an improvement to an interior of a building that is put into service after the original building was put into service, that's going to be now called qualified improvement property. The one mistake they made was they forgot to say that it's 15-year property, which means it defaults to 39-year property, which means it's not eligible for bonus depreciation. So what they did was they went back in here and said that's now going to be 15-year property, which means it's going to be it's going to qualify as 100% bonus depreciation. So we have one client right now who, because they didn't want NOL carry forwards, so they weren't taking bonus depreciation because they couldn't carry the NOLs back. So they weren't taking bonus depreciation. So we now have an opportunity to amend 2 years worth of tax returns for them, take bonus depreciation on everything that they did not previously take bonus depreciation on. We can also now take bonus depreciation on all of their qualified improvement property, carry this net operating loss back to 2017 and get them approximately $500,000 back. So there's definitely opportunities there. You need to start looking at your fixed asset listing to see what was classified as 39-year property that could now be classified as 15-year property. In an ideal scenario where you didn't elect out of bonus depreciation, you could do this via a method change on your 19 return if you haven't filed that yet, as opposed to going back and amending. But you're going to want to look to see, what's going to be the fastest way to do this. The IRS is, I will note, the IRS is completely shut down right now, with the exception of processing payments, both receiving payments and getting refunds out. So hopefully, the sooner we can get this stuff filed, the sooner we're going to be able to get cash back. Excise tax relief, yeah, they removed the excise taxes on alcohol if you're going to be making hand sanitizer. Some of the more popular good news headlines are that breweries, distilleries are now starting to make hand sanitizer. So they're able to buy all of their alcohol and save on the excise taxes as an encouragement to do that. So other stuff in the CARES Act that we want to make sure we note: forgiveness, small business loans forgiven, mortgage obligations forgiven, other loan obligations forgiven by the lender, not going to be includable in income. I think that addresses a question we got earlier. High deductible health plan, the safe harbor from that for that is we're permitting telehealth services to be included in that. That's exciting. Pension funding relief. So if you can't meet your contribution obligation for a defined benefit plan, again, that's a defined benefit plan as opposed to a defined contribution plan, you're going to get relief if you weren't able to fund that appropriately. Distributions from retirement plans. If you have a qualified plan and you need to take an early withdrawal from that, usually there's a 10% penalty. That's going to be waived. And you're going to be able to pick it up in income over a 3-year period as opposed to picking it up in income in 2020. Plus, if you recontribute the withdrawn amounts within 3 years, it's not going to have to get picked up in income at all. So basically, and again, on the next slide, we're going to cover the specific loan scenarios. Previously, you were able to take a loan of up to $50,000 from a qualified plan. They doubled that to $100,000. The required minimum distributions, if you haven't taken that yet from an IRA, they've removed the requirement, which seems kind of counterintuitive when you say, well, wait, we want to get cash back in people's hands. But at the same time, if I have a significant amount of money that's invested in an IRA that's invested in the stock market, I don't want to take money out now. I want to leave it in there because we're all expecting the stock market to come roaring back in the next 6 months. So if I can leave that in there, I'm going to be better off in the long run if I don't need it. So yeah, next point. Yeah, we covered the loans from 401k up to $100,000 instead of normally $50,000. And if you have a 401k loan, you can defer, so you can delay that up to a year. Few other things to note. The government's incentivizing everyone to be making charitable contributions. Obviously, a lot of organizations now are going to need that more than ever. What they did was they put an interesting thing in there. The Tax Cut and Jobs Act eliminated tax benefits for smaller contributions because they increased the standard deduction for married filing joint to $24,000. So if you were making a few $100 contribution, you weren't getting a tax benefit for that you're not already getting. So what they did was they put in $300 as an above the line deduction. So if you do not itemize your deductions and you make $300 worth of contributions, you're going to get the tax benefit for that. Sounds like a small number, but when you multiply $300 times every single taxpayer out there, it adds up pretty quick. And when they want to make sure people get the tax benefit for that. Cash contributions, they suspended the AGI limitation. Previously, it was about 60%, depending on the type of contribution. So that's going to be up to 100% of your AGI now. Anything above 100%, you're going to be able to carry forward. Charitable contributions for C corporations. Previously, it was 10% of your taxable income. Now that they're increasing that to 25%. And if you are in a position where you can get enhanced contributions, deductions for food inventory, previously it was 15%. They're upping that now to 25%. Student loan relief. So student loan repayments are for federal student loans are suspended. No interest payments are required, and they're not going to be garnishing wages or tax refunds for student loan debt collection.
Okay. All right. Well, Mark, that was efficient the way you got through there. There's a couple more questions that did come in. One of them is, are cell phones considered utilities under the loan forgiveness program? Yes, they are. The loan forgiveness program discusses that payments for utilities include electric, gas, water, transportation, telephone, or internet. So I would say that cell phones would be in that number. It was also discussed, Mark, that can you take the tax benefits that were just outlined here if you have a payroll protection loan or a disaster loan? I would assume yes. I mean, I'd assume that the taxes that are the tax benefits that are outlined here doesn't really matter if you're an organization that's taken any of these loans.
That's correct. So they combined kind of a legal thing here with the CARES Act with changes to the Internal Revenue Code. So yes, all the things we just talked about for qualified improvement property, AMT credits, net operating losses, yeah, they are completely independent of all of the Paycheck protection loans, et cetera, in the CARES Act.
Another question was, can you apply for a disaster loan and a payroll protection loan? Is there a deadline? Is that today? So yes, you can apply for both if you'd like. There is the deadline is not today. However, there would be if for the PPL loans, you would want to apply for the PPL loan between now and June 30th. But the disaster loans could last for a little bit of time here, as long as the state's considered a disaster area. The other question here was, can student loans be payroll deducted pre-tax like medical insurance? That's an interesting question. I don't know the answer to that one. Mark, any thoughts on that one?
Sorry, Dave, I was scrolling through the questions here. Can you repeat that?
Yeah. Can student loans be payroll deducted pre-tax like medical insurance?
At this point, I'm not aware of anything that would allow that. So the if you are getting payments from your employer, this is in the Families First Act. If you're getting payments from your employer, you can get those now tax-free to pay off student loan debt, even for undergrad. Your employer could pay for graduate school up to, I believe it's $5,250 per employee. They've expanded that to repayment of student loan debt. Now you can't do both. You're maxed out at $5,000. I think it's $5,250 for both programs. So if you want to take the money for student loan debt, you can either take it for student loan debt or for master's classes, not both.
Right. Okay. Let me see what else we got here. Question-wise there, Mark. How do you apply for a PPL loan? I mean, it's going to be through an SBA qualified lender. So again, you would want to make sure that you talk to that. You would talk to your bank. If your bank does SBA loans, I'll be talking to that lender right now. But all these SBA loan, all these PPL loans will be administered by the SBA. Do payroll costs include premiums for workers' compensation insurance? That's a good question. From my understanding, no, because they were saying that when you include insurance, it's group healthcare benefits, and the insurance premiums related to the group healthcare benefits. It would not be workers' compensation insurance, but we can get some more clarification on that too. That might be something that comes out with further guidance from the SBA.
Yeah, I saw one here about the 500 employee limitation. We ran into this initially last week under the Families First Act because that was the initiation of the 500 employee limit. That goes back to the FMLA law. So if you read the Families First Act, it actually changes FMLA rule up to 500 employees. And then if you dig further into that, the only guidance is it's based on multiple entities. So if you have multiple entities under common ownership and common control, all of those entities are going to be grouped together for this test. So if you have 100 employees and 6 different entities all owned by the same ownership, all under the same control, you're going to blow that 500 employee test. The next question of that is, how is the 500 determined on any given day? Is it an average for the year? That's going to be hopefully included in the regs, the specifics on how to measure that. I don't believe we have guidance for that yet. And that's a question on the FMLA side as well.
Yeah, there's another question here. It says, are both principal and interest forgiven or just principal on the loan? And I think the question relates to the PPL loan. So, I mean, that's a good question. I would assume that the interest is going to, based upon the way this loan works, is that it's going to be principal that's forgiven. If there's any remaining principal at the end of the forgiveness period, that interest would be accrued on that principal and then paid over the 10-year period at the 4% or less interest rate. But again, I think that's going to be some additional guidance that's going to come out from the SBA about at the forgiveness period, how do the utilities and the payroll and the mortgages get the cost to run your business, how does it get applied into the actual loan to bring the principal balance down for forgiveness?
Yeah, I'm seeing multiple questions on here. What if I haven't laid anyone off yet? Can I still qualify for one of these loans? Absolutely.
Absolutely. Yep.
That's the goal of these loans, so that you don't have to lay people off, so that they don't have to go on unemployment. These loans are meant to be a stopgap to keep everyone from going on unemployment.
Yeah, and also, I mean, again, going back to the fact that, you know, if you did lay people off, the whole intent of this loan is for you to bring them back on the payroll so the federal government can get them off of unemployment. So again, yeah, if you haven't laid anybody off, yes, you still qualify for this.
All right. I think we have to cut it off here at some point. We very much appreciate everybody joining us today. We would encourage you to continually check our website. We're updating that, like I said, daily. Often it's multiple times a day. Contact us with your questions. We would love to be setting up meetings with people to help walk them through this. We're the ones digging into the details. We need you guys to be out there running your businesses, keeping people employed, and we'll help you any and every way we can. Just please reach out and we'll set up a meeting.
Mark, thank you very much for that. And Mark's 100% right. I mean, as things continue to change and evolve here, we're going to continue to update our website, and you can find our website at www.macpas.com, and the COVID-19 portion of the website will come up immediately when you come onto our website. And when you click in there, you'll see a number of different articles and resources of information that are out there that we've set up for small businesses, large businesses, whoever it is to use. So again, if you need anything, we don't have all the answers, and I wish we did, you know what I'm saying, Mark? But the fact is, we're going to continue to dig to get the final answers so everybody knows what to expect in the next 5 to 10 business days, because as the SBA begins to roll out these payroll protection loans, we want everybody to be in a good spot that they can get in the front of the line and get those loans so we can get people back employed and we can position ourselves for coming out of this coronavirus pandemic crisis that we're in. So with that being said, on behalf of McKonly and Asbury, I just want to thank everybody for joining the webinar. And we're going to put these slides out there on our website as soon as possible so everybody has access to this information. And we'll get this information up to you as soon as possible. And again, we'll be updating the website on a regular basis as information becomes available. Again, thank you, everybody. We appreciate it. Have a nice day. Stay healthy. Thank you.